Many business lawyers are called on to advise public charities such as their kids' schools and sports leagues, soup kitchens and homeless shelters, museums and cultural institutions, community foundations, and the occasional private foundation set up by a good client. While much of the legal work for established nonprofits is the same as for any other business clients, the tax-exempt status of these entities brings with it a host of income, property, and sales tax rules that are not necessarily obvious. This episode highlights the most likely tax issues to arise for public charities and private foundations, typically organized as corporations, that are described in Internal Revenue Code Section 501c3. Similar traps exist for other common kinds of nonprofits, for example, social welfare organizations, trade associations, and social clubs. But other special rules also apply to those types of entities and are beyond the scope of this episode. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So let's dive right in and talk about 5 tax traps for business lawyers. Number 1, just because it's tax exempt doesn't mean no income taxes are due. Nonprofits are subject to federal and sometimes state income tax on their unrelated business taxable income, commonly referred to as UBTI. The policy behind these rules is that nonprofits should not take advantage of their tax-exempt status and undercut the prices charged by taxable businesses that carry out the same or similar business activities. For example, operating a fitness club may well be charitable and educational, but if it is operated as commercial competition to for-profit fitness clubs, why should it have the competitive advantage of operating tax-free? Net income from an activity operated by a charity will be taxable if the activity meets the following 4 criteria. Number 1, the activity is a trade or business. Number 2, regularly carried on. 3, is unrelated to the organization's exempt function. And 4, is not covered by an exception or statutory modification. Note that occasional activities are not going to be caught in the snares of the unrelated business income tax. The high school drama department's car wash may well compete with the local gas station car wash, but if it is just one Saturday each year, it is not regularly carried on for these purposes. There are also several exceptions, termed modifications, to UBTI. These exceptions cover passive activities that generate income from rents, royalties, interest, and dividends, as well as capital gains on investment income. But here again, there's another exception to this exception. Any income other than exempt function income that is financed by debt will also be subject to UBIT in the same proportion as the debt bears to the acquisition cost of the asset generating the income. And of course, there is an exception to the exception for debt on property when it was contributed to the charity, provided that the debt is more than 10 years old before the contribution. Another common UBIT trap is sprung when a nonprofit accepts corporate sponsorship payments in order to promote the organization's mission and raise funds for the organization. Charities must understand the differences between non-taxable corporate sponsorships on the one hand and payments that are taxable advertising income on the other. Fortunately, the IRS has created safe harbor regs regarding the tax treatment of corporate sponsorship payments. These regs permit the charity to accept a payment from a corporate sponsor as long as the sponsor does not receive a substantial return benefit. These substantial benefits are things such as advertising, endorsement, exclusive provider arrangements, and some other similar benefits. So, what can charities provide the sponsor without running afoul of the IRS safe harbor? The charity can do any of the following 3 things. The charity can use, acknowledge, or publish the sponsor's name, phone numbers, internet address, locations, logos, slogans in print media, or on the charity's website, as long as the acknowledgement does not also include descriptions of the company's products or services, links to the sponsor's website, or similar benefits. Number 2, display a sponsor's products or services or distribute free samples of a sponsor's products at a nonprofit event, although the charity cannot do anything to endorse that product or service. And third, provide a website link to route the viewer only to the sponsor's homepage, but not pages where the product or service is marketed, sold, or advertised. Within this framework, though, the charity cannot do the following. The charity cannot include any sponsor messages or materials that promote or advocate for the sponsor's business, services, or products. It cannot include pricing or saving information or make comparisons with other businesses. The charity also cannot provide a message that includes both corporate sponsorship and advertising. In short, a charity can fundraise by seeking corporate sponsorships without having to pay taxes on this income, but it should be clear with the sponsor about what the charity can and cannot offer in return. A written sponsorship agreement that describes return benefits that fit within these safe harbors should be carefully drafted to avoid the U-bit trap. So moving on to tax trap number 2. Beware employment and withholding taxes. Nonprofits, other than churches, which have some special rules, and we're not going to talk about those here, nonprofits are subject to the same employment and withholding obligations as for-profit businesses. Because of cost pressures, nonprofits often are tempted to push the boundaries of treating service providers as independent contractors rather than employees, and sometimes are tempted to pay interns stipends that may violate minimum wage laws. Nonprofits should also be careful when compensating the president and chief financial officers as independent contractors. Note that these are statutory employees for purposes of federal wage withholding rules. These rules are all nicely stated on an IRS website, and I'll have the link to that in the show notes. On a related note, volunteer officers are too frequently a bycatch of the responsible person penalties. Let me explain. Certain officers are treated as responsible persons under the Treasury regs, and those are the officers that have the duty to perform or the power to direct the acts of collecting, accounting for, or paying over employment trust fund taxes. Just as is the case with for-profit entities, if such a responsible person fails to ensure that the charity pays over the withheld taxes, the IRS can actually collect the amount due from the volunteer personally. Of course, the organization's insurance is unlikely to protect the volunteer director or officer who is stuck with this liability. So, a word to the wise. Volunteer officers who are president or CFO should be absolutely sure that withheld taxes are timely paid over to the IRS. Moving on, tax trap number 3. Advocacy and lobbying can spell trouble under the Internal Revenue Code and state laws. As the 2022 election season approaches, or if you're listening to this podcast in a later year, in even years when there is an election, many charities and foundations face important opportunities to advance their mission in the political arena. Both charities and foundations are subject to specific and numerous prohibitions on participating in campaigns for elected office, and running afoul of these rules could trigger a deadly trap for the nonprofit. Specifically, charities and foundations must not do any of the following activities: endorse a candidate for public office, urge the public to vote for or against a specific candidate, contribute money or anything of value to an election campaign, form or support a PAC, that is, a political action committee, provide mailing lists to candidates, including emails, of course, score or grade candidates, provide campaign workers to campaigns for public office, support or oppose political party platforms, and the final one in this list is provide website or social media links to any candidate, party, or PAC website. Now, a special note here about candidate appearances at events sponsored by a nonprofit that involve an incumbent office holder running for re-election. These kinds of appearances can be permissible in some circumstances, but be sure to check the Internal Revenue Code rules and regulations before allowing any activity that includes a candidate at the nonprofit. Similarly, voter registration drives are permissible if properly managed within the rules so as to be entirely nonpartisan. That's an overview of candidate campaign activities. It's important to distinguish that from policy advocacy and limited legislative lobbying activities. Some policy advocacy and legislative lobbying is permissible for public charities up to certain limits. However, keep in mind that private foundations are prohibited from influencing legislation and may risk losing their tax-exempt status by doing so. This prohibition for private foundations includes both grassroots lobbying, that is, attempts to influence legislation through an attempt to affect the opinions of the general public, and direct lobbying, which is any communication with any member or staff member of a legislative body or any governmental official, which communication refers to a specific piece of legislation. In addition, every call to action where a private foundation encourages the public to contact a legislator is prohibited. So let's talk about when it is allowable to advocate for policy changes that are within a public charity's mission. There are several exceptions. Communications that address broad social, economic, and similar issues will be perfectly acceptable for both public charities and private foundations as long as the advocacy is not merely propaganda and does not use code or buzzwords to oppose or support a candidate. Furthermore, foundations and public charities may engage in nonpartisan analysis, study, and research as long as that activity does not advocate the adoption of legislation or legislative action to implement the findings. Although these activities are prohibited for private foundations, public charities are allowed to engage in both grassroots and direct lobbying so long as the activity is not substantial. There are two tests for substantiality. For public charities that want to engage in lobbying, here are the two tests for substantiality. The facts and circumstances test that considers all facts as well as the amount of money spent, and the objective test, on the other hand, which is the other test that applies to public charities that have made the election under Internal Revenue Code Section 501H. These lobbying rules are complex, but the IRS provides a good overview of the rules on its website, which will be linked in the show notes. You may also want to go back and take a listen to episodes 6, 7, and 8 of the EO radio show, where we do a deeper dive into candidate activities and legislative lobbying. So, to summarize, the best protection against inadvertently falling into a tax trap and becoming embroiled in impermissible political activities is to ensure that the organization has a policy in place that clearly describes for staff and board members the parameters of permissible advocacy. This policy should also prohibit the use of the organization's assets for any candidate activity and require staff to report any potential issues to the organization's executive director or to the board. Of course, staff can individually participate in candidate and advocacy activities on their own time, but they should never use the organization's resources, including email, conference rooms, or paid time, to engage in any of these prohibited activities. The organization's policies should clearly state that employees must use their private addresses and networks and personal time when it comes to political activism relating to candidate activities and any lobbying that is outside the scope of what is permitted for the organization. Tax trap number 4. Compensating insiders for goods and services requires attention to detail. Just because an individual works for a charity does not mean that person must donate all or part of his or her time to the organization. In fact, many service providers to nonprofits are paid. Tax traps frequently arise, though, when insiders and management are paid too handsomely for their services to the organization. Aside from the public relations dilemma that many charities face when they pay excessive compensation, the Internal Revenue Code includes no-kill traps that penalize the self-dealing insider and management without harming the nonprofit itself. The Treasury regs set forth the rules that insiders must follow in order to avoid these punitive excise tax penalties that may apply to excessively compensated insiders and the board members who approve the compensation arrangement. In order to avoid the penalties that apply to excess benefit transactions in the case of public charities or self-dealing transactions in the case of private foundations, the compensation arrangement must be reasonable and should be documented very carefully in the minutes of a board of directors meeting, or, if necessary, by a board committee meeting, or alternatively by unanimous written consent of the board members. The following 4-step process should be followed in every instance of insider compensation, as well as any increase in salary or benefits that is not an increase that applies across the board to all staff members. So here are the 4 steps in the process. The transaction must be approved in advance by the board or a committee that is permitted by state law to act on behalf of the board. Number 2, the board members approving the transaction or compensation arrangement may include only individuals who do not have a conflict of interest with respect to the compensation arrangement, and all conflicted individuals should recuse themselves from the discussion. Process number 3, the board must obtain and rely upon appropriate comparability data, which I'll talk about in a minute, prior to making its determination. And number 4, the board must properly document the basis for its determination concurrently with making the decision that the compensation arrangement is reasonable. So, what is adequate documentation of a compensation arrangement? Adequate documentation should include the following 7 components. 1, the board's knowledge of the material facts and the director's interest in the compensation arrangement. Number 2, the documentation should be clear that the organization is entering into the transaction for the benefit of the organization. 3, documentation should show that the transaction is fair and reasonable to the organization. 4, the documentation should include specific terms of the compensation arrangement, including the annual salary, all benefits, and the date that the compensation arrangement was approved. Number 5, a complete list of the board members who were present during the debate and who voted on it. Number 6, comparability data and a description of how the data was obtained. And number 7, the actions taken by the board with respect to consideration of the compensation arrangement by anyone who did have a conflict of interest. In order to document properly any reasonable compensation arrangement for an insider, the board should gather and evaluate this data regarding comparable salaries ordinarily paid for like services by similar organizations in similar geographic regions. This data can be derived from independent industry surveys, documented compensation of persons holding similar positions in similar organizations in the same area, expert compensation studies, or other evidence of comparability. The board should review and attach to the resolution approving the compensation a comprehensive job description for the position, a current resume for the insider, a statement of the insider's qualifications for the position, and all components of the salary, including all benefits and perks provided. For other types of transactions, that is, insider transactions that don't involve compensation but cover things such as purchase or leasing of property from an insider and similar kinds of arrangements, independent appraisals are the best evidence of reasonableness. And keep in mind that private foundations generally cannot enter into any sale or lease transactions with insiders, regardless of how fair or reasonable the arrangement may be. So, moving on, tax trap number 5. The all-important IRS Form 990. In the charitable world, there is perhaps no document as important and scrutinized as much as the organization's annual tax return, which is known as the IRS Form 990. Every tax-exempt organization that does not pay federal income taxes must file the IRS Form 990, although private foundations file a variant of the 990 referred to as the 990-PF for private foundation. A number of other non-charitable tax-exempt organizations, such as chambers of commerce, labor unions, and social clubs, also file the 990, but they don't file all of the schedules that apply to a public charity. Smaller organizations may qualify to file the shorter 990-EZ form, and the smallest organizations, those with annual gross receipts normally $50,000 or less, need only file an electronic Form 990-N, referred to as an e-postcard return. Beware, however, that an organization that fails to file its 990 for 3 consecutive years will find itself trapped in an automatic revocation of its tax-exempt status. Although the revocation can in many cases be reversed, it is a huge hassle to get out of this trap unscathed. So prompt annual filing should be a high priority for every nonprofit that wants to remain tax-exempt. Because the Form 990 provides a powerful looking glass into an organization's mission, operations, governance, employees, and board members, organizations need to be more thoughtful than ever in preparing the Form 990. This full Form 990 may require the skills of accountants, tax advisors, and sometimes even public relations specialists, and most definitely will require a careful review by the organization's leadership and its board members. In addition to the expected financial information, the Form 990, that is the full Form 990, not the EZ or the postcard 990N, the full Form 990 includes questions in several detailed schedules, those are schedules A through R, that touch on the traps discussed above. Unrelated trade or business activities are also disclosed on a separate return, that is the 990T. See the show notes for a complete list of the schedules and links to these forms. So, summarizing these 5 tax traps, the Internal Revenue Code and Treasury regs are replete with traps for the unwary nonprofit. Since the consequences of missing one of these issues can include tax audits, penalty taxes, and bad press for an organization, and in the very worst case, the loss of an organization's tax-exempt status, business lawyers advising nonprofits should be extra cautious when stepping into the role of tax counsel to the organization. Avoiding income tax on funds raised, making sure that all employment taxes are paid when due, steering clear of impermissible candidate and lobbying activities, justifying reasonable compensation, and reporting on all of the above accurately on the annual Form 990 are fundamental compliance matters of which every counsel to a nonprofit must be aware. So that's all for this episode. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Varela, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.